everyone, you're welcome to my channel Promotion for Sure. In this video, we are going to talk about Chapter 13 Operational Risk and Integrated Risk Management, Module B Risk Management of CAIIB course. Now, in this chapter, we will understand and learn the operational risk, classification of operational risk, management of operational risk, measurement approaches to operational risk, integrated risk, and issues of integrated risk management. Now, operational risk would arise due to the deviation from the normal and planned functioning of systems, procedures, technology, and human failures of omission and commission. Now, operational risk may also arise due to inherent failure or faults in the system, procedure, technology of an organization, which may also impact its revenue adversely. The Basel Committee has defined operational risk as follows: the risk of loss resulting from inadequate or failed internal processes, people, and system, or from external event is called operational risk. So operational risk classification can be done in various ways. People oriented causes such as negligence, incompetence, insufficient training, integrity. Uh, Second is process oriented, which is business volume fluctuation, organization complexity, product complexity, and major changes. Third classification is process oriented at operational control level, which is inadequate segregation of duties, lack of management supervision, inadequate procedures. Fourth is technology oriented causes, which is poor technology and telecom, obsolete application, lack of automation, information system complexity, poor design, development, and testing. External causes, natural disasters, operational failures of third party, deteriorated social or political context. So if we talk about event based, it is internal fraud, external fraud, employment practices and workplace safety, clients, products, and business practices, damage to physical assets, business disruptions, and system failures. Execution, delivery, and process management also forms the event based operational risk. Now, operational risk classification uh, by definition. So, we have already discussed different categories of operational risk. Now, let's talk about operational risk management practices. Now, the Basel Committee on Banking Supervision had outlined the principle that provided a framework for effective management and supervision of operational risk for use by banks and supervisory authority when evaluating operational risk management policies. So, this policy and risk management environment involves a lot of different aspects: risk monitoring and control practices, collection of operational risk data, regular monitoring and feedback mechanism, collation of incident reporting data to assess frequency and probability of occurrence of operational risk event, monitoring and control of management of large exposure. So if we have to quantify the operational risk, it has three uh, ways: the basic indicator approach, the standardized approach, and the advanced measurement approach. So let's first talk about the basic indicator approach. Now, banks using the basic indicator approach must hold capital for operational risk equal to the average over the previous 3 years of a fixed percentage, which is 15% of the positive annual gross income. So, gross income is defined as the net interest income plus net non interest income. It is intended that this measure should be gross form of any provision, be gross of operating expenses. It excludes realized profits or losses from the sale of securities in the banking book, and it should also exclude the extraordinary or irregular items. So this is the basic indicator approach. Now let's talk about standardized approach. Now in the standardized approach, bank activities are divided into 8 business lines. So what are these 8 business lines? Corporate finance, trading and sales, retail banking, commercial banking, payment and settlement, agency services, asset management, and retail brokerage. Within each business line, gross income is a broad indicator that serves a proxy for the sale of business operations and thus the likely scale of operational risk exposure within each of these business lines. So, advanced bank management approach, which is the third approach. Under this approach, the regulatory capital requirement will equal the risk measure generated by banks' internal operational risk measurement system using the quantitative and qualitative criteria for the AMA. So, this is also another way of measuring operational risk. Now, operational risk mitigation. The mitigation of operational risk basically lies in the qualitative approach in operational risk framework adopted and its implementation. So, insurance cover where available may provide mitigation of risk. Capital allowance under insurance is available only where the advanced management approach has adopted estimating capital for operational risk and is subject to certain conditions. So, what is scenario analysis? In addition, scenario analysis should be used to assess the impact of deviations from the correlation assumptions embedded in the bank's operational risk management framework, in particular to evaluate potential losses arising from multiple simultaneous operational risk loss events. Now, what is integrated risk management? Now, integrated risk management is managing all risks that are associated with the activities undertaken across the entire organization. In the context of banking industry or banking organization, risks that are associated with it are liquidity risk, interest rate risk, market risk, credit risk, and operational risk in the various forms. The common factor in all these risks lies in the possible downside impact on the revenue of an organization. The sum total of all risk impact is critical factor for all the organization. So integrated risk management approach has the process which consists of strategy, organization, process and system. So this is something which we all should be aware of. So let me ask you certain questions and I hope you'll be able to answer these questions. Operational risk arises from question number 2. The international convergence of capital measurement and capital standards recommendation. Okay, benefits of an integrated risk framework are rewards of proper management of operation risk are. So I hope this video would have given you a lot of valuable insight and would have given you valuable information. So if you have reached our channel and you have watched this video, please subscribe and become a lifetime learner. You can also like and share this video among your colleagues. Thank you. Have a great day. Bye bye.